Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Taking a look at Netflix today, stock is up almost 10%. Is it because their Q4 earnings were good, or is it because people are excited about Exo Kitty Season 2? Nobody knows. For the year, the stock has almost doubled, so that's exciting for shareholders of Netflix. Unfortunately, I am not one, but wanted to take a look at these earnings and see if the valuation still makes sense for the year. Revenue up about 16%, operating margins expanding 6 points to 27%. That's pretty impressive. And for the quarter, they're adding 19 million paid net adds, finishing the year with 302 million members. That does include those additional members that you can add to your account if you're account sharing. They had a bunch of content. Squid Game Season 2 performed very well. That Jake Paul versus Mike Tyson fight became the most streamed sporting event of all time. Somehow, that probably won't last forever, but that's still pretty impressive. And then on Christmas Day, they had the two most streamed NFL games in history. Probably a lot of this stuff driving a lot of these net adds. People do like sports, and Netflix is really diving into those. They have the WWE starting in 2025. I think they signed a deal for the Women's FIFA World Championship starting in 2027, more NFL in 2026, probably other stuff happening as well. And they have Squid Game Wednesday and Stranger Things on tap for 2025 as well. And that's really what Netflix does well. It's about content cadence. Content quality is also there at times, but at the end of the day, these guys are releasing a show every third day or a movie every third day, whereas with Disney Plus, with Max, with some of these other streaming services, I probably have to wait a couple of weeks to get something new. In Max, it's like, hey, one season ends of something, another season of something else begins, whereas with Netflix, a bunch of stuff is running concurrently, and that's really what Netflix is doing well. If you were to be forced to only have one streaming service, I think most people would choose Netflix, and that's why Netflix has the lowest churn. People are starting to do that thing where they sign up for a service for a month or two, cancel, sign up for another service, watch a bunch of stuff there, cancel, repeat with a bunch of different streaming services. But I think Netflix has the lowest churn out of all of these streaming services, which means people are staying for longer and not canceling and resubscribing later, because Netflix is releasing content so consistently, and that is really what you need as a streaming service to maintain low churn. That's why their growth is still there, and that's why they have pricing power as well. They're raising prices again on the ad-supported tier, up $1. On the non-ad tiers, they're going up anywhere from $2 to $2.50 depending on the tier you've chosen. So obviously they're kind of incenting people to go into the ad-supported tier. They're making more money there from advertising on top of the fee that you pay. I pay the $15.49, so my fee's going up to $17.99. Will I cancel? Probably not. At the end of the day, Netflix does provide a lot of value. If you compare the content you get with Netflix versus what people used to pay from cable or still currently pay with cable, there's a big difference, right? You could probably raise Netflix another couple of bucks and people wouldn't think twice about subscribing to it. Maybe more people will start churning, but end of day, I think there's still some room to raise prices here. However, eventually they'll probably raise it enough so that people will start to think about canceling, and maybe the global paid membership will eventually start to see a drop, or at least the growth will slow down substantially. However, it's kind of seemed like growth was slowing down right here, but then boom, they come out with a 19 million net ad quarter, and people are pretty impressed with that. When you look at Netflix, though, you kind of think about maybe this is a mature business. Obviously, the ads speak to the reverse of that. And also, when you think about how many people watch Netflix, there's still plenty of eyeballs that can be out there that Netflix can capture. There's an estimate that there's 750 million broadband households. If you exclude China and Russia, that number's only going to continue to grow. There's 650 billion in entertainment revenue that's out there in the markets they operate in. They're only capturing 6% of that. And again, that probably includes movie theaters and all of that other stuff, music, etc. So maybe they can't capture all of that, but there's probably a bit of upside there. And then if you look at TV viewing habits in every country, they're less than 10% of TV viewing in every country they operate in. So plenty of upside for streaming growth. Again, and streaming, while somewhat of a mature business, there's still a lot of people that have cable subscriptions, still a lot of people that watch old school television. They're going to eventually move to streaming, and stuff like the NFL is going to make that happen faster, as evidenced by the number of additions they had this quarter. It's pretty impressive, but they do have to maintain relatively sizable revenue growth. When you see what happened in 22 and 23, revenue dropped from 18% to 6%, stock dropped from $600 to $200. Now revenue picked up after that. They instituted additional fees for additional members for account sharing. They added that ad-supported streaming option, and revenue growth returned, margin expansion returned. However, the valuation assumes that that's going to continue. When you think about Netflix, you look at the valuation, and before we do that, disclaimer, video is purely for informational, educational, and entertainment purposes only. It is not investment advice. So when you look at the valuation, it's $407 billion right now on a market cap basis, 413 enterprise value, not a lot of debt here, so that's good. Compare that to Disney. That has a parks business, a movie business, sports ESPN business, and a streaming business, and that's trading at a 250 billion enterprise value. Is this overvalued? Is that undervalued? Hard question to answer, but obviously there's potential upside to something like Disney if they can execute their streaming strategy well, because of what Netflix has become. Similar to Warner Brothers Discovery, I do have long-term leaps in that. That also has a streaming business in Max, but again, that's 110 million subscribers versus 300 million here. But that has an enterprise value of 70 million, includes a television business, a movie business, and a streaming business. But that streaming business, again, not profitable. Same with Disney, same with Paramount Plus, not really profitable in a free cash flow basis. Netflix is the future of television, has kind of won the streaming wars in my mind, has the best cadence content, the most quantity, maybe not the best quality, depending on who you ask, but end of day, they are well ahead of all of these other players, and all of these other players are where they are because, yes, they have a streaming business and other stuff, but that other stuff outside of Disney's parks business is kind of dying in a way. Legacy TV, movies, not all that exciting anymore, while streaming obviously has a growth path ahead of it. Eyeballs are moving there. Eventually, the eyeballs are going to be on streaming, and Netflix has run away with it. They had a head start. They've also executed well, and they have a plan that's working well for them and is really showing up in the results. As we look at the valuation here, again, it's expensive, 1.7% on a trailing free cash flow basis, 2.1% on a next 12-month basis. So they do have to execute well, continue to execute well. Within these assumptions, you can see they're pretty aggressive. Low teens growth for the next 3 years, high single digits after that for the next 2 years. Margins expanding by about 700 basis points, 100% of their money going towards buybacks. That's pretty close to what they've shown in the last 2 years. Maybe it's a bit aggressive. Maybe I'll switch that to 90%. But the majority of their free cash flow after expenses for all the content they produce is going to go towards stock buybacks. I do think they'll institute a dividend in the next couple of years, not anytime soon, but a couple of years down the line, they certainly will. So there's some money left for dividends. If you want to do that, you can play around with the dividends here if you'd like. But end of day, I'll put this at a 3% free cash flow yield when this is a more mature business, still growing in 2029, even if it's mid to high single digits, with potential for slightly more margin expansion. And assuming a 10% target return, I get a fair value that's about 5% shy of where it's trading at after today's bump, an expected return of about 9% from today. And again, these are pretty aggressive assumptions. You have to kind of assume this to make sense of the valuation. Are you comfortable with the idea that margins are going to expand another 700 basis points from where they are today? Are you comfortable with growth being what it was in the last year or close to it for another 2 to 3 years before slowing down a little bit, but still continuing to grow in the high single digits, high-ish single digits? Are you comfortable with the market giving this a 3% free cash flow yield? Because if you're not, this is probably a bit aggressive for you. And maybe you have to look at a 4% free cash flow yield, in which case you get about a 3.7% total return from today's price point. And that's not all that exciting. And that still assumes these relatively aggressive assumptions. You get a fair value at that level of about $711. So really, I think to make sense of today's prices, you do have to have pretty aggressive assumptions here. You have to have, we're going to grow at 10% or so for the next 5 years. We're going to improve margins of the company by 700 to 800 basis points. We're going to use 90% of that free cash flow towards buybacks to improve buyback yield. And we're going to execute to achieve all that. And even after that, we're going to have to get a 3% free cash flow yield from the market as a more mature business in the face of all of the other competition, of all the other streaming services that are out there. Is that achievable? Can they grow their revenue by another 20 million in the next 5 years? Do you believe that as a shareholder? If not, you should probably take some of these shares off the table. If I were a shareholder right now, I probably would sell a little bit. It seems like the valuation is getting to the fair to excessive point. It doesn't mean that I think this is dead money or anything like that. I think this is still an amazing business. Certainly the best streaming service that's out there. If you feel like you want to invest in streaming, this is probably going to be the winner in the long run. It's just that the valuation sort of shows that that assumption is already baked in to the price that you're getting today. And yes, you can look at Disney and say, well, Disney is 150 billion less than this, and you get all this other stuff. That's true, but can Disney do with Disney Plus and Hulu what Netflix did with Netflix? Right now, not really. I don't think those services are anywhere close to Netflix in terms of content quality, in terms of content quantity. They still have to get there. They're not bad by any means, but they have to show that there's profitability in that business, and they haven't shown that yet. Same with Max. Max is expanding to various countries outside of their current markets. They have the potential to reach, 200 members with full expansion, 200 million members rather, with full expansion there. And there's certainly upside in that stock, but there's also some risk with the legacy business fading and their movie business being kind of an unknown and the amount of debt that they have, whereas Netflix is kind of a clearer path forward. They're raising prices as long as they have the pricing power to continue doing that for the next couple of years, and they don't start losing members in a big way. This stock should kind of keep chugging along, probably returning in the neighborhood of 7 to 10% from today's prices. Now, the risk lies, what if something like what happened in 22 and 23 happens, right? The assumptions here are pretty aggressive. Margins have to expand. Revenue has to keep growing. If suddenly they lose members and revenue drops a bit more than projected, this stock could have a pretty substantial move in the other direction, which is why if I held some shares, I'd probably sell just a little bit. However, I'm not gonna, because I don't hold any. So let me know what you think about Netflix. Are you a buyer here? Are you a seller? Do you hold? Again, if I had some, I'd sell maybe 50%, leave the rest, let it ride. If this stock does somehow drop into the 700s, would I buy some Netflix? Totally. Think it's a great company, awesome service. I think users love it. And I think they're going to continue to love it despite the fact that they're raising prices. I think they have the pricing power to do so for at least the next couple of years. Eventually, maybe there'll be a breaking point. I don't think we're anywhere close to that. So let me know down below what you think about Netflix, about the earnings, about the company. What's your favorite Netflix show? Let me see what mine would be. Maybe Ozark. Ozark's pretty good. Although I haven't really finished it, so I gotta finish that show. I'm way behind on a lot of these shows, but Ozark is pretty awesome. I'm watching The Night Agent right now. Certainly not my favorite show, but it's one of those things where like Netflix releases these things that are just fine. Like The Night Agent is fine. It's perfectly fine. It's not bad. It's not great. It's watchable, but it's there. And next week there's going to be another show that's fine. And every once in a while there'll be a show that's really good. And you'll be like, wow, this is pretty solid. But in the meantime, I'll watch all these other fine shows because they help me sort of do something when I'm bored or tired or whatever. And that's where Netflix really shines. If you're bored and tired or whatever, Netflix is there for you. So pay $17.99 to help fill that void. So thanks for watching. Hope you're having a good day. Like, subscribe. Bye.